welcome back to Go Baby Go TV. I'm Louie Hillman, joined by my partner, the Optimist guy, Brian Setzler. Brian, today we're talking about the bank failures bonanza. Historic events in the last few weeks, two of the largest bank failures in the history of our country. Hard to even know where to start, but your thoughts on that overall, and obviously there is a significant decline in consumer confidence right now.
Yes, it has been a decline. There's a lot of things that are bad about it. It's bad that it happened. It's bad the decisions that were made that caused it to happen, all of which were avoidable. You know, these morons that are running that bank, they're worried about diversity, inclusion, climate change, instead of asset and liability matching on the balance sheet of that bank. It's just over the top. Provide 10-year maturity bonds backing up cash deposits, and then they wonder why they have a problem when people start taking their money out. Now, the other thing that's interesting about that is the speed at which that many people tried to take money out of a financial institution. We've never seen that in history. It's not just the second largest bank failure. It's the first time social media essentially has caused a run on a bank. Don't you find that one little piece of it interesting?
Yeah, absolutely. Well, in the simplest terms, can you just go back and explain what events caused this to happen? And specifically, Silicon Valley Bank has been the one that's been at the forefront of the two big failures.
Yeah, my understanding is that the fixed income securities that they chose to buy on their balance sheet during the last several years when interest rates were very, very, very low, the Fed suppressed interest rates. And now it's easy to see that they did that. And the consequence of that is that it forced the consumer to take more risk with their own money over the last decade. So if you read the financial press, most people say that because interest rates were low, the consumer had no choice but to take more risk. I don't know if that's completely true or not. We, as you know, sell index products. So we always thought that index products offered certainly more than a 0% expected rate of return, but it also did so in a safe way. I guess it is maybe accurate that forgetting index products, setting those aside for a second, the average consumer might very well have been buying equity-based instruments, whether it be managed accounts, individual stocks, mutual funds, ETFs, and so on, all of which had a greater degree of volatility than something like a bank savings. But because the rates were low, it motivated the people that ran the bank to also make bad investment decisions. In this case, they bought bonds with longer maturities in order to get a higher yield. So if they had to pay the consumer zero in a checking account, if they could find a way to make 1.5% in 10-year bonds or 2% or whatever the coupon was, they thought they were being geniuses, because 2% net spread on billions of dollars adds up, and that profit was inuring to the benefit of the bank. But when rates spike like they have over the last year or so by 4.25%, because the Fed was too late to raise rates, and now they've, first of all, Janet Yellen is not competent. She shouldn't have the job. Powell, I don't think, is competent either. They both appear like they've completely lost control of themselves. They're political acts. They're not serious bank people, in my opinion. And so she's the one that said inflation was transitory. It's incredible that she said such a thing at a time when you could not buy anything. You couldn't buy a new car on the lot because you couldn't find anything. So of course, price was going to go up. Anyway, inflation went up. They had to deal with it. So their only lever to pull was to manipulate rates. So now they have raised rates so much. And then now those bank depositors, in an effort to try to get a higher rate of return elsewhere, are taking money out of banks that are paying them zero to try to get a higher yield. Well, if too many people take too much money out of a bank at the same time, it causes a run on the bank. And then in this case, if social media influenced that, by a bigger run of the bank than would otherwise have happened because of fear, then they just couldn't liquidate securities fast enough, and the securities they did liquidate are worth less than what they paid because interest rates moved, which caused that bond portfolio to go down in value. So there was no way out for the bank unless the government came in and helped them. You know,
There's no way to describe it besides fragile in terms of the consumer confidence, right, in financial institutions right now, after all of this has happened. How do we as advisors give them confidence in insurance companies? And how are insurance companies different than banks?
well, insurance companies are over-capitalized as opposed to banks, which I think in many cases are undercapitalized, depending on how you look at it. Insurance companies are not at the mercy of immediate liquidity events because they don't sell checking accounts. You know what I mean? Like the nature of a checking account is the money is there for a short-term period and anybody can take the money anytime they want. My concern is if the consumer loses complete confidence in the banking system, even though they do have FDIC protection up to $250,000. If 40 or 50 relatively uneducated Americans decided to take 10,000 or 20 or 30,000 out of their account tomorrow, I don't think the banking system could take it. You know what I mean? That's the real concern that no one's talking about. What if the average guy takes out 10,000 multiplied by, millions of people at one time across the whole system? Would the government, would FDIC have the money to even cover a $250,000 guarantee? That would be my question. Is it really backed up? I don't think it is.
Well, and that's,
You know,
those kind of concerns are on people's minds right now. Should they have that same concern when they are putting their money with an insurance company? Are there more protections?
yeah, you have insurance guarantee funds, which are a state level insurance, very similar to FDIC. So there's that. But number one, there's never been a life insurance failure that caused a consumer to lose the money in the account. It's never happened in history. People just don't know that. It's never happened. And it won't happen because the industry is not only overcapitalized, but it's regulated by the government in a more onerous way than the banks are. And they're regulated by a different part of, it's not the same group of people. So anyway, I have tremendous confidence in life insurance solvency because they have more money than they need to pay their claims,
Yeah. Well, it's very insightful. We appreciate the conversation. And, if you're looking for any resources as it relates to financial stability of the insurance companies that you're representing, please reach out to us. But we'll be back next Monday, always to help you rev up your week with some actionable information, whether it's a sales idea, like today, industry insights, or market updates. Our goal here is to help you turbocharge your sales. So we'll see you next Monday and make it a great day.
Thanks for listening.